Hey, it's Nathan with optionsforall.com. In this video, we're going to go over short iron condors, which is a neutral options trading strategy. We're going to go over what a short iron condor is, then we'll hop over to Robinhood and go through a few examples, and finally, we'll close out on Robinhood Legend, and I'll show you how to do short iron condors over there. So let's go ahead and get into it. So here we are on a handy dandy cheat sheet, and in this video, we're going over the iron condor, in particular, the short iron condor, which is a credit trade. There's also a long iron condor, which is a debit trade. And I'll have another video on that, but we're doing the credit trade right now. This is when we are neutral, so we think the stock's going to stay, in a certain range for whatever expiration date or period of time that we select. To open the trade, we're basically doing a put credit spread and a call credit spread. And if you don't know how to do credit spread trades, I recommend watching that video first because it'll make this one make a lot more sense. I'm not going to go over all this because this looks kind of crazy right here. It does make sense once you understand what's going on. And when we go through the examples, it's going to make, perfect sense. But I do recommend checking out my credit spread video first because it'll help you tremendously in understanding the short iron condor. Alright, so what is a short iron condor? A short iron condor is a neutral option strategy that profits when a stock or ETF stays in a range. It's built using 4 options with the same expiration. On the put side, you sell a put closer to the money and buy a lower strike put. That's the put credit spread. And on the call side, you sell a call closer to the money and buy a higher strike call. So that's the call credit spread. So like I said, you need to understand put credit spreads and call credit spreads before you can truly understand a short iron condor. But you put those together and you've got a short iron condor, basically a put credit spread and a call credit spread combined around where the stock is currently trading. You typically use a short iron condor when you expect the stock or ETF to stay in a range, so not make a huge move up or down. And implied volatility is still relatively high, so that way the option premiums are richer and you can collect more credit. And you're okay with limited profit in exchange for defined risk. So a short iron condor is a defined risk strategy. That means you know how much money you could lose up front, but you're also capped on the potential profit. So you also know what your potential profit is up front as well. And it has a relatively high probability of making something if price stays in your zone. Now, it's a great strategy for sideways and choppy markets where you don't have a strong directional opinion, but you're happy to get paid while the stock chops around. Now, how to set up a short iron condor? Here's a simple way to think of setting one up. Pick your expiration, choose a single expiration date for all 4 options, often somewhere in the 20 to 45 day to expiration range, depending on your particular style. And that's because Theta or time decay will work in your favor for these short iron condors. And it also gives you time to adjust, like if the stock starts moving outside of your particular iron condor, you have enough time to employ different defensive strategies, like rolling your iron condor legs. Now, you choose a price range, so decide on a range where you think the stock is likely to stay until expiration. The lower bound of that range will guide your put strikes. The upper bound will guide your call strikes. You build the put credit spread below the current price. You sell a put at a strike where you're comfortable owning risk. And you buy a lower strike put to cap your downside risk. Now, this creates your short put spread and brings in a credit. And then you build the call credit spread above the current price, which means you sell a call at a strike above where you think the stock is unlikely to go. You buy a higher strike call to cap your upside risk. This creates your short call spread and brings in more credit. Then you check the distance and risk reward. So the distance between the strikes on each side, so that's the spread width, defines your max risk per side minus the total credit received, and you want to make sure that the total credit you collect fits your risk reward criteria. Then you want to place the trade as one iron condor order. Most brokers, so Robinhood, will let you enter all 4 legs as a single iron condor ticket, so you see the net credit clearly. So it does all the math for you, and you'll see that in the example. You see the potential profit and loss all right there in one order ticket. And moving on down to how it makes and loses money. When you open a short iron condor, you collect a net credit up front. Your maximum profit is that credit that you received. You keep it if the stock finishes between your short put and your short call at expiration. Your maximum loss is limited because you bought the further out of the money options on both sides. Those long options cap the risk on the put spread and the call spread. And so that way you know your max profit and max loss going into the trade. Now, the pros of a short iron condor, so we have defined risk. You know exactly how much you can lose. It's theta positive, so time decay works in your favor. As days go by, the options you sold lose value, which helps you. You have a reasonably high probability of profit if you choose a wide enough strike. So price can move around inside your range and you can still win. And it's a neutral strategy. You don't need to predict direction, just that the price won't go too far up or down. Now the cons of a short iron condor, it's limited profit. Your max gain is just the credit you received. You're risking a larger amount to make a smaller amount. And also you can lose on either side. So a big move up or a big move down can push price through one of your spreads and into your max loss territory. So if the stock does not stay flat or neutral between your range and it goes way up or way down, you could lose the max potential loss that you had going into the trade. There's also the risk of assignment, and this is the same with all options that you short. So if your short options go in the money, especially near expiration, you can get assigned. And then also the short iron condor is sensitive to volatility changes. If implied volatility expands after you enter, the position can show a loss even if price hasn't moved much. However, this gets negated the closer you get to expiration, assuming the price stays neutral. So quick summary, a short iron condor is a put credit spread and a call credit spread combined around the current price, designed to profit if the stock stays in a range. You get defined risk, defined reward, and you're basically betting on not too high, not too low, just stay in the middle. So we got some Three Little Bears stuff going on right there. All right, let's head over to Robinhood and set this thing up. So I'm gonna go to SPY, SPY, and we will set up an iron condor over here. And we want to go to trade SPY options. And I'm gonna go about 30 days out. We'll come out here, 30 to 45 days. We'll go December 26th, day after Christmas. All right, so we're gonna go ahead and start off by setting up our put credit spread. So let me switch to put, and I also want to sell first. So we're going to open up our short put position first. So I wanna go below the current price of the stock. So it's currently sitting at 673.34, and I wanna go out of the money. So I'm gonna just look at the deltas. We'll go for a 0.2 delta, and here we go. We got a 0.19 delta and a 0.21 delta. And we can see that the strike price is $5 gap right here. And so that's something to be mindful of. Sometimes the further out of the money you go, they start spreading out the strike prices. Like if I come up here, you can see that it's $1 between each strike price. But as I continue to go further out of the money, they start gapping $5 at a time. And I'm gonna go with the 640 strike. So we'll go ahead and we'll sell that particular position. So we're selling the 640 put, and you can see where that takes us. So max profit, $591. Max loss is $63,409. So that's just simply selling a put, or in this case, it's kind of like a cash secured put. And I have a video on doing cash secured puts if you're not sure what that actually is. But now we need to go ahead and buy our put option, so that way we set up our spread. So I'm going to do $630, and we'll go ahead and buy this particular option. So there we go. I have my put credit spread, and we can see that my max profit is $116, max loss is $884, my break even is $638.84. And let's look at this chart for a second. So we can see our max loss is between $630 and our max profit is above our short put strike price, which is $640. So as long as the price of SPY stays above $640, I would get my max expected profit, which is $116. Now let's go ahead and do the call side. So come up to the call side, and we're going to be selling our call first. And let's go to a 0.2 delta. Let's go up here, 0.2. So we have 701 strike price. And I'm going to go ahead and add that to my order. And then I also need to buy my long call position. So let's switch it over to buy. And I want to do a similar width, so I'm going to look for a 711 strike price, and we can see that it started gapping by $5 instead of $1, so the strike price I'm going to go with is 710. We'll go ahead and add that to our order. And now let's take a look at our trade ticket. So we have a short iron condor set up, which is what we've been talking about. So it's good to see Robinhood agrees that we've set up what we thought we've set up. We're going to be selling the 640 put, we'll be buying the 630 put, we'll be selling the 701 call, and buying the 710 call, all with the same expiration date of 12/26. And we can see our total credit is 229. So that's our max profit right there. And let's scroll on down for our max profit of 287. And the reason for the different credit and max profit potential is over here. We'll click on continue. So you can see that I'm doing a limit price at 287. So that's where the credit actually gets calculated with the actual price that I'm going to be conducting the trade for. So we see the 286.84. So now our numbers, match up. Our estimated credit, our max profit now match. Our max loss is $713, so we know that going in. And then we want the price to stay between our two short legs. So ideally, it stays between $640 and $701. That is our max profit range where we keep all of our credit. And you can see where we break even if it drops down to 637.13, and then we start losing money if it goes lower than that. And then we also could break even on the upside if the price of SPY goes past 703.87, and then we start losing money on the upside if it starts ripping. And like I've previously said, there are different defensive strategies. So if the price of SPY starts going up and starts kind of testing your upper call, you could go ahead and roll that position up or maybe out and up. Additionally, you could go ahead and bring your put credit spread up as well, or out and up as well. So you could kind of move the whole iron condor up and out if you need to. And I have a video on rolling multi-leg options, so I recommend checking that out for that particular defensive strategy. But that's how you can set up a short iron condor within Robinhood. Now let's go ahead and do it on Robinhood Legend as well, and we're gonna go kind of quick over here. Now let me load up the SPY ticker symbol. So we'll load that up. So we got our option chain out here, and let's go to the day after Christmas, so December 26th. So we're going to go ahead and open the put side first. That's just personal preference. I just open the put side first, then I come over and I do the call side. So let's go to a 0.2 delta. Let's look. And so we got the 0.19, and we want to go ahead and sell that position first. So we're shorting it. So we're on the bid side, 635. We'll go ahead and sell that. And we'll go ahead and buy the 625 strike price put option for $4.22. So there is our SPY put credit spread. Then we need to come over and do the call side. So come on over, we'll look for 0.2 delta again, and we got a 0.2 delta right here, exactly 0.2 on 701. So we're going to go ahead and sell that one. So the bid side, we're going to be shorting, selling the 701 call option, and we're going to buy the 710. So on the ask side, we're going to go ahead and buy the 710 strike price. And we can see that we have the SPY short iron condor set up, and we can see all the order information right here, our max profit, max loss, break evens, and so on. And we could go ahead and click submit order if you're ready to open that particular short iron condor. And so that's it for this video. Hopefully you found it helpful. If you did, I appreciate it. And start with likes, comments, subscribes, anything like that. And I hope you have a great rest of the day.